Quantum began in 1990 as India's first equity research house. The founder of the company, Ajit Dayal, began the company and started recruiting research analysts. The initial years went in advising or writing research reports for Indian institutions, and then after 1992, when foreigners were allowed to invest in India, Quantum was writing research reports for well-known institutions such as Jardine Fleming, Kleinworth Benson, Yasuda Partners. Between 92 to 95, Quantum had a joint venture with Jardine Fleming, and then Ajit left Jardine and came back in 96. I, Subbu, joined in 1996. We spent the first few years advising different groups, learning long-term style of money management, learning the value style of money management, learning both the retail side of the business and the institutional side of the business. We did all of that till 2004. During that phase, we had a phenomenal exposure and experience in terms of understanding companies from different sectors as well as from different countries. So both Ajit and I had exposure to international companies like Nestle, Unilever, Cimex, Lafarge, Holcim, Beijing Datang, all very well-known companies, and that allowed us to analyze and understand the Indian companies much better. During this period, we also hired analysts and trained them up to think in a similar fashion. In 2004, we raised capital to apply for a mutual fund license. We got the license in 2005, 2006, and then we launched Quantum Long-Term Equity Fund in March 2006. We have been then adding product in each of the years. We subsequently added a fixed income product, the liquid fund, and then the gold ETF, and then the fund of funds and the multi-asset fund. We also have an index ETF. Every time we launch a product, the question we would ask ourselves would be not the market size of for the product, but whether the product would make sense for the retail Indian investor or not. If we thought that it would make sense, then we were happy to launch the product, and that is what has been the philosophy right from day one. We also decided not to use the distribution system right from the day we launched the mutual fund. There were two reasons for that. A, we found the system to be very opaque. B, we also found that because of the opaqueness, it led to a lot of churn, and the final returns which the investor was getting was not adequate to really compensate him for the risk he took. So we decided to go direct, and that had a huge benefit in a variety of ways. It kept the costs and the expense ratios low. B, it allowed us to communicate directly with the end customer. That was again a huge positive, because during bad times, if somebody communicates to you and tells you, when I say bad times, I mean a very volatile, choppy market, you normally would become nervous if you are not aware as to what are the reasons for the choppiness. And if you are able to communicate at that time with the retail investor and tell them the reasons for the choppiness, then we found them to be much more receptive to remain in the fund, and as opposed to redeem it, and that allowed us to have much more stickier assets. So net the direct communication helped, and we have been following that till date. And I think our philosophy would continue to be launch products if it makes great sense for the retail investor, and look at the overall expense ratios. We would never launch a product which had a high expense ratio with high fees for ourselves. We want to be adequately compensated, but at the same time we don't want the retail investor to be paying through the nose. That's in some sense sums up our strategy as far as mutual fund business is concerned. Thanks.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.